Hello, everyone. Good morning. Today is January 28, 2020, Friday of expiry. My name is Josip Kosik. After checking the sound is good, I want to welcome you to the Trading with the UFOs. This is a disclaimer here. The following videos are for educational purposes only. We are not a financial advisor. If you have any questions, you can send it to support. And if you want to get in touch with us, please make sure that you email us at josip at tradeactive.com. We have address right here in case you want to get in touch with me or with the support. And we're going to look at the current market environment. We have an open trade on XLE. And at the end, we're going to have a new open position called bear call spread. So basically, the agenda is to have these things done in such a way that we have all three things um, presented. So I'm gonna use the three things. I'm gonna use a Word document. I'm gonna use the top platform, and I'm gonna execute on Thinkorswim. So the agenda for today, number one, I like to call it the big picture. And what I mean by picture, we're going to look at diamonds. We're going to look at the SPY. We're going to look at QQQ. And we're going to look at the IWM on a monthly in relationship to what's going on. And that should not take more than about 10 minutes of our time. Number two, we have a review of the open trade on the XLE. We're going to look at that and we're going to see if we can tweak it, improve it, or whatever. And number three, we're going to present a bear call spread. So this is agenda for today. So we have 57 minutes left. So what we're going to do now also show that we have a place where you can get in touch with us, and that's Trading with the UFOs. If you scroll it all the way down here, you can book the coaching if you want. But if you have any questions, this is where you go to look at my notes. So, for instance, I posted notes from last session where I was trading XLE, and it has the details, and I'm going to come back to these details in a moment. But before that, I want to point out to you the big picture that I updated, and I was pointing out that IWM and SPY have taken out their respective December monthly lows, and this is pretty much where I'm going to start right now, which means that I'm going to go to the 4 monthly workspace where I had built the diamonds, the QQQ, the SPY, as well as the IWM. So I'm going to start with the IWM because IWM is the weakest of all of them. And what I'm showing over here is really a monthly bar of the December that has been violated to the downside. This red line represents the low of the December, and we have taken it out, and we are now virtually, we don't even have a wick here. We're at the low. It's interesting, market is kind of like a going sideways, but the Russell is not going sideways. And what is really significant about this whole thing is that for the last 10 months, with the exception of the January, February, when the market ripped on the Russell, we've been going sideways, and now we have actually lost that, and we are going down. So for my agenda of the bear call spread, I definitely have now a candidate that I could trade the bear call spread, and that is going to be IWM. And the reason why I would do that, because IWM is simply the weakest of them all. Oh, thank you very much for getting back to me through the chat. It seems to me the sound is good, and that the issue has been resolved and that we are looking good. So I'm going to now proceed now looking at which one is the strongest one. And the reason why I have all four of them here, so you can focus on the tails. So obviously the biggest tail that you see is actually tail on diamonds. While when you're looking over here on, let's say, the QQQ, the tail exists, but it's not really that big. It's a kind of SPY actually has a bigger tail than QQQ. So the one that is actually back above the December low, it's a diamond. So definitely we should not be considering going short on a diamond, because a diamond actually has a potential to even go higher. Because what really you could do when you're evaluating this on a bigger time frame, consider this as a borderline between the two enemy sides. And if the enemy has pushed into the other side territory and they've been rebuffed and they're back now within their borders, that's a sign that the bears are not winning, but that the bulls are defending their borders. So definitely, as I pointed out to you, the four ETFs that we're looking at are indicating that IWM is weakest and diamond is actually the strongest. And these two that are in between, we're not going to do anything about them, right? We're not going to do anything about them. We're going to just be aware of it, that we have a candidate for a bear call spread on IWM. So having said that, I would like to now open up the options with option plays. This now workplace is something that I want to really focus on slowly. And I know I'm going to evaluate the XLE in a moment, but I just want to finish my evaluation of the IWM and point out to you that in the terms of the standard deviations, we usually have 4 standard deviations, statistically speaking, that market is going down. Now, what you would notice over here, that we on IWM have lost 9-day exponential moving average 16 days ago. Well, Joseph, how do you know it's really 16 days ago? Well, the way how I know that it's 16 days ago, it's very simple, that over here in this area, they're showing to me that currently we're down for 16 days, right? That doesn't mean that this is the best time for us to go short, but if I keep in mind that on this side, I have a UFO, and this UFO, it's showing me the lowest number of the 193.72. What I can do with that particular number, I can actually, in my mind, already come up with what I'm going to do with the bear call spread when the bear call spread comes up. So when the bear call spread comes up, I'm going to be looking at that a little bit higher, 194, as a selling to open, which really spells out STO, and then I would be buying a higher unit. So the unit that I'm going to be buying, it can be anything. It can be 195 or it can be 196. Now the difference between these two is that if I pick this particular case, then I would be risking about the $200. And I would like to actually do that on options that are expiring today. But anyway, let me now just go back and look at the diamonds one more time to finish the evaluation on the daily. And as you can see, on the diamonds, what is taking place, standard deviation shows that usually for 4 days, statistically speaking, in the past, based on the data, diamond has been going down. Now the diamond has lost this particular 9-day moving average 10 days ago. And again, how do we know that? Well, we know that by looking at the currently what is happening. So basically, IWM has been down 6 more days versus the diamonds being down only about 10 days. So again, this is already showing us somewhat of the uptrend. So when you're looking here and you're concluding that perhaps if we're going to do anything with bullish trades, diamond is in an uptrend. It's going to take maybe only 1 or 2 sessions before it crosses this 9-day exponential moving average. And then after that, there's a high chance that we may actually head up. So anyway, we do have 2 candidates that we can entertain, one for a bullish side, one for the bearish side. But the reason why I changed this background behind me in the red, because I really want to teach the bear call spread today. Now, can I review what do we have on the XLE? Because the XLE was a trade that I actually placed, and I made sure that it's clear that I'm bringing up now information from my options with options notes as a review. XLE is a bullish trade. The energy sector in a down environment was holding up quite well. Even on the heavy down days, it was still up. At the time of the entry, XLE was at the 63.80. That's the piece of information that we need to remember when we look it up here. And right now, it's at 65, 64.96, right? So I want you to be aware of it that with the trade that we currently have open, XLE, we're actually up. And what I'm going to do now, I'm going to bring in the Thinkorswim platform to refresh the memory to the students of what we have done. So if I go here in account statement and I open up my option, you would see that over here we have 2 bull put spreads. These 2 bull put spread that we did for the sake of financing. We did for the sake of financing the call spread. So what we did over here, we sold twice 60 put for $1.19. And then we went ahead and we hedged ourselves 5 points lower just in case we are wrong with a 55 put. So in order for us to have a spread, I had to have an equal size. So I have a sold 2 on the top and I have a bought 2 on the bottom. And out of the premium that we took in of the $1.19, we actually have gotten the 42 cents debit. So that's mean our spread right here received the credit of the 77 cents times 2. That's $144. While over here, this particular spread that we have actually has costed me about $2. So when I go over here, I have here explained in the pieces. Part 1, my bull call that involve buying of the 60 call and selling of the 63 call. And currently we're at the 65.17. So we had to achieve our target. It was costing me $2. Okay. The most that we can make on it, well, actually I got filled $1.98. But anyway, besides the point, if this is a $2 and this is a $3 spread, the most that I can make, it's about the $1.02. Having said that, I want to now point out to you, this is open trade. This is that $2 that you're looking here, and this is now $5.95, $3.75. That's mean if I were about to close this, if I went ahead and closed this, this is now $2.22. So I made right now, if I was about to do this, I can probably try to squeeze it to get out at the $2.30, right? So then I would make a 30 cents on this particular investment. However, I'm going to delete this because what I want to point out to you that I actually have a working order. And if anybody remembers, feel free to type in the chat box. What do you think that working order is? The target or the stop? And I'm going to just sip the water here for a moment because I believe that some of you remember that this was actually a conditional order that says sell at the market with the good to cancel if the XLE drops below the 60. By the way, the same stop, the very same stop exists on my bull put spread. So bull put spread we sold. So over here, if you're looking at this area that I have here, that it's pointing out that I'm talking about the bull put spread. If I sold that, the activity that is opposite to that needs to be buy. And I'm buying at the market in terms of the premium when this particular condition is being met. That's mean if it dropped below the 60. So it's very important to know that when we are doing trading, that everything goes back. Everything goes back to what? To what the chart is saying to us. So what is the chart now saying to us on IWM? On the IWM, just remove this. Not on IWM, on the XLE, we have picked the 60 of this area right here. So this area right here would be the area that I have a stop right here at this 60. So obviously the price has lifted. Now it's going sideways. There's a possibility that we might have a one more leg up. And that's why I was thinking this morning when I was preparing for a session to kind of discuss what is it that we can do over here with the XLE. So obviously with the XLV, we have a long, it's called bull call spread, that is currently profitable. And we have a short vertical that had financed the cost, some of the cost, right? So this bull call that we did was, I think, if I'm not mistaken, about the $2 of the debit. And I have shown you that we are now profitable because we are above $2 and whatever, that was 22 cents, right? And if you want to actually visually picture that, it always helps to kind of have things spell out here. So my entry versus my exit. So if I know that right now we're sitting at 65.21, and if I bring again the documents that I posted for everybody to see, when we had entered, it was at 63.80. It was at 63.80. Okay, and I can copy specifics of this particular information so you would know. So entry was 63.80. The first part was my bull call spread. So it was about $2. And right now we know that it's trading above, right? The most that it can make is basically $1, but I would need to be sitting through that thing all the way till the February 18. And we have now already pierced this thing. So my $60 call while we are at 65.21 is in the money by $5.21. So you might be scratching yourself and asking, how in the world is then this bad trade? Well, it's a bad trade because we have selected the 63. You see, right now we traded a bull call spread for $5.20. It has ripped to $6. And you're like, why would that rip to $6? It's a functionality of the delta. What do you mean by that? Well, the functionality of the delta means that if we had lifted, we only get whatever the delta is. However, what I want to point out to you that what is killing me was my wrong selection of the strike price that I have selected at 63, because I have selected 63 call. 63 call. I sold it for $3.10, and now I would need to cover it up for 77.5 cents more. So I've shot myself in the foot. So there's a number of things that you can say that it could be done to tweak this particular trade, right? And what I want to point out to you that it could be done, but I'm not necessarily having that in mind, because I mentioned to you that my lesson is going to be on, and I'm making this sure that you understand, on a bear call spread. I could go ahead and this 63 call that is sold, I can remove it and close it for a loss, right? That would leave me with a $60 call that is still open. I personally don't like that. What I actually like to do is following. I'm going to bring in my position here. I'm going to scroll it down where it says XLE. Okay, so this is XLE. I'm going to just simply copy that. I'm going to show the risk graph. And when I show the risk graph, you would recognize that at this area is a 63. And the reason why I'm pointing out this area is a 63, because the expression is that leg is broken right here at 63. And currently, we are already here at the 65.46 in that area. So that's mean there's no fixing here. There's no fixing here. What we could do rather than complicating this, keep the bull put spread. Keep the bull put spread. And my bull put spread is right here. So I'm going to get the risk graph of the bull put spread. And I'm going to actually consider this as a successful trade. Because if you're here at the 65, I can actually keep that, because we're about 5 points away from my sold unit. So what I'm going to do, and I'm going to really make this very, very simple. I'm going to explain to you that my plan is to exit the bull call for whatever profit there is, and then place an out of the money bear call. And that's going to be the nice introduction for me teaching you later on bear call spread on IWM. Okay, so what I'm going to do next is I'm going to bring the option chain here. And in this option chain, I'm going to get rid of everything except the 18th. So I'm going to be looking at the 18th, and I'm going to be looking at the strike prices that are higher than. So I'm selecting here long call. I'm going to go bearish, and I'm going to select the strategy that's called bear call spread. So this is going to give me a 2 legs. So because we're right now trading at 65.31, I'm going to revisit the chart one more time so I can have a chart actually tell me where can I put this. So I'm looking here, the highest we have ever traded was a 66.95. So I will take that piece of information and I would actually start to work in such a way that I'm going to create a template here. And by the way, that template is going to get posted and you guys can definitely have it. So we're going to have out here price, then I'm going to have a space between that price, and here it's going to be the sold leg, right? So if I now go slowly over here and type in, currently we're trading at the 65.37 on the XLE. I noticed that we have a high of the 66.95. That is a high. So I'm going to select the 67 call that I'm going to be selling. And I'm going to add a space above it. Oops, that's not quite what I wanted, but that's okay. I'm going to just go over here and get rid of that and select the one above. Select the one above. So I'm going to have a bought leg, BTO, that it's going to be maybe 69 call. So in that case, I will be investing about $2. But one thing that I want you always to pay attention to, it's liquidity. And what I mean by liquidity is not just the open interest, but also the volume. So what I'm doing right now, I'm going back to the chain. I'm pulling up the chain. I'm going to enlarge this so it can be more visible. And because every time when I open it, they squeeze me several of these expirations. So I'm getting rid of the 18th, and I'm selecting only, March 18th. I'm selecting only February 18th. And then when I go over here at the money, these are the choices that I have. So I said that I know I want to do the 69, and I know that I said I want to do the higher one, which is 67 and a 69. So I'm highlighting here the choices from a multiple strike prices to 67 and a 69. So if we are currently sitting at 65, 66 is out of the money, 67 is 2 steps out of the money. I want to now to see if open interest, and also the volume is good. So these are the two areas that I'm talking about when I talk about liquidity. And by the way, we're just doing with the calls. We're not even dealing with the puts here. So just keep in mind, the puts are not our concern. Our concerns are only the calls. So what I want to do now, I want to point out to you that we have actually very, very good liquidity. Anything over 4 digits, it's very good. So we have a 4 digits, meaning thousands of open interest contract at a strike price that is 67. Okay, so I'm going to just float this for a second so I can show you one more time on a chart what I'm talking about. So when I move this, I have noticed that the high is a 67.95. So because I know the high is a 67.95, I'm actually placing my big bear call spread right on the top. But let the professionals tell me, let the market makers tell me where is the highest activity. And I'm gonna mark this with the blue, and I want to tell you that this is really poking my eyes. I might say, oh, mathematically speaking, due to the chart, but this is where the activity is. And activity is at the what? 68. So now that I know it's at 68, all that I'm going to do is I'm going to use the 68 as my sold unit, and I can still use 69 or I can even go to the 70. Or I can even go to the 70. So I want to now just observe what is happening here with the 69. 69 has a 13,363 contracts, and 70 has a 14,444. I got my answer. Thank you, market makers. You have left a footprint. I see it, and I'm going to alter my original plan, because my original plan was good in theory, but the question is, where are the big boys? So the big boys are not at 67, 69. The big boys are at the 70. Okay? So knowing that, what I'm going to do now is simply this. This is already prepared for me. So I'm going to now, one more time, click here, bearish, bear call spread. So I have two legs right here. And what I'm going to be doing now, to make this a little bit more obvious, I'm going to alter from a 67 to 68, and from 69 to 70. So now it's easier to see that I'm actually talking about only about these colored lines. These colored lines are all that matters to me, and I think yellow looks good, so I can actually circle this in yellow and work with you slowly. The 68 is the one that we are selling, and every time when we're selling it at the bid. So this bid is currently $23. So what I'm going to do right now, I'm going to click on that bid, and I want you to notice that this has actually filled up for me the 68. In a moment, I'm going to be now changing the color to green, so I can tell you this is the one that I'm buying. So I'm buying the 70, and every time when you're buying it at ask, and this is now using the money that we received from this one to finance that one. So I'm going to now clicking on the 76, and I'm going to now edit the spread, because I have legs that were inserted to me by the default that I don't want it. And this is what we have here. We have here selling the 68, which is a lower strike price when compared to the 70, which is a higher strike price, and buying the 70. And now when I click OK, what is going to happen over here in this particular area, and I'm going to use the orange to point out to you that I'm getting the total of the 54 cents. 54 cents. So what I'm going to do next now is very, very simple. I'm going to copy this position into a clipboard, and I'm going to now go back to my positions, and when I select the risk graph for my bull put spread, so here's my bull put spread, I'm going to get the risk graph. I'm going to have a compare the spread. And this compare the spread is going to, okay, I'm going to just click here, spread, copy, and I'm going to then alter it from a bull put into the bear call. And I'm going to edit that into the strike prices that we dealt with, which is selling the 68 and buying the 70. Selling the 68, buying the 70. So I'm selling the 68, buying the 70, and I click OK. So what this thing is going to do, but I still have that other position on, so let me now remove first from the paper trading account this particular thing. So before I do that, I just want to make sure that you're aware of it. I have $1,000 tied up here. And you're saying, well, why is $1,000 tied up here? $1,000 is tied up here for a simple reason, that I have a spread that is $5 wide, and it's a twice. So really the long call is not an issue, because the long call had been paid with the financing from the bull put. So what I want to do, I want to actually exit this. But if you want to see the rejection, you're going to see it because I have already working order over here with the stop. So if you are ever trading kind of emotional and you go ahead and say like create a closing order at 227, let's get greedy, 230. So in that case, you need 30 cents. Boop, reject. It's supposed to say rejected. Well, in the real platform would say rejected. Like now, obviously you can see right here, I'm sitting in a sim trading, and for some reason in the sim trading, it's not getting rejected. But in real life, this would get rejected because you can't have two working orders on the same thing. So what I would need to do is go back over here, get rid of my stop, right? Why am I replacing my stop? Because now I'm closing for a profit. Profit right now, it says 68 cents. We were up even more today, but that doesn't matter, because right now I'm trying to close this for 230. If it's not working, I usually wait about the 2 minutes and then I start dropping to 2 cents lower. Right now it's 8:37 and I still have a IWM to teach, so I better hurry up. Okay, so I've exited at 228. Okay, so let me now make sure that you guys are not losing me on this. Over here, we paid for this $2 and we got closed for $2.28. So how much did we make? How about if I just say about 10%? How is it 10%? Well, think about it. You had a $200 when you opened. When you closed, you got a $220, $28. It's actually 28%. That's actually more than 10%. That's more than 10%. Okay? So that's a good trade. Now, check this out. That has done nothing to reduce my buying power effect. Because do I still have two contracts, each $5 wide? Yes, I do. Then what do I need to do? Well, first of all, I need to pay attention that I only have about 22 minutes left and I still need to teach you IWM. So I need to hurry up and I need to place a trade on a February on a call side that it's selling the 68 that is out of the money. These are all out of the money. If you're looking right here, and I'm going to make this in orange so you can see it. This is intrinsic value. 64 plus the $1.46, it's giving me the current price of the 65.46. 65, which is called at the money, has only 46 cents of the value. 66, 67, 68, they have a value of nada, nothing. So I'm up here trying to sell for $1.30 while returning them 81 cents. So what I'm doing right now, I single right click. I'm going to go ahead sell only one at first, only one. Or what I can do to make sure that it doesn't get away from me, because I have a two contract, right away start to do two contracts. So I'm trying to get 16 cents. Let's try to get to 18 cents. So what does it mean? Well, take a look. That's wrong. What is wrong? I did not change the top unit. So we are selling the vertical, we're selling the 68, but we need to be buying the what? 70. So this is now $200. I'm going to try to get it for 55 cents. So $2. Okay, let's make sure that I do one unit only. And then once when I get filled, I would quickly then change it to the second unit. So $200 minus 55 that they owe me, because they're going to give me this 55, means that I don't need to have in my account $200. All that I need to have is $245 plus, of course, the commission over here. It says your commission is this, which is 65 cents times 2, because we have two contracts, one for buying, one for selling. So out of the credit, they're gonna pay themselves this much. Okay, so I'm gonna send this, see if I'm gonna get filled. If not, I will need to walk it down. So the beautiful thing is when you have these things, okay, now I got filled for, oh, I got the price improvement 56. That's great. Let's try to do one more time. You will notice that my buying power is not going to change at all. They gave me the first time for the 56, but now they won't give me it for 56. But I need to move on to the next one and drop it down. Okay, so the first one I got 56, second one I got 54. So why is this still says working? Oh, because I have a, oh yeah, look at this. When I cancel this, my buying power stays that way. But if I place one more of these, and let's play one more of these at some crazy credit that they're not going to give it to me. They're not going to give me for 60 cents. The moment I click this, my buying power is going to jump. I mean, my margin is going to change to 1,500 after I get filled. Anyway, that's besides the point. The point is that I have utilized the $1,000 here. So let's now recap what we are doing here. What we are having here now, it's iron condor. It's iron condor. So let me now explain to you. If I now go edit the spread and I add another option leg and another option leg, what do? We traded the calls. So we have a call and we have a call. Feel free to type in the box if you remember which price did I buy, strike price, and which price did I sell. And I'm going to just take a sip of water here while you guys are engaged here with me. So on the bottom, I have a $60, and over here I have a 5. This is not the proper iron condor, right? What is happening here with this iron condor that I'm risking here $1,000, and over here I'm risking only $200. So if I want to do something, I can actually make more contracts on it. But I want you to see this and to interact here with me in the box so you would realize what is happening right now. So what I'm doing right now, showing to you that in account, I'm not proportionate. And what I mean by that I'm not proportionate, because on this one, I have a $1,000 invested. On this one, I only have a what? $400 invested. So what can I do? Well, I can send how many more? Well, 4 more. So let's go and quickly add more of these. So I'm gonna now go over here where it says a trade history. I'm gonna aim to place 1, 2, 3, 4. 4 more for 56. See if I'm gonna get filled. Oops. I shouldn't have done the 4 because now it's more than what I needed. Anyway, when you're in a rush, you know, that's what usually happens. So now over here I have a sold unit, 68. Bought unit, 70. And I click OK, and you get the iron condor. Now this iron condor is not proportionate because of the sizes. So what I'm going to do right now, show you that we did 6 of these. 6 of these, and then these legs, well, they're still not completely normal because I shouldn't have done the 6, I should have done 5. So if I take one away, then it's going to be more balanced. You see how now it's more balanced? It's having $1,000. So what I have done here as an error, when I was trading, I went ahead and I placed it 4. Well, how do you fix this? Well, this is how you fix it. Create an opposite order, right? So I'm closing one of them for a debit of the what? 55. So why would you do that? Josip, I don't follow you. I lost you. Oh my God, what are you talking about? I want this to drop down to what? $1,000 even. So because I want this to drop down, I would need to take away from 6 of them, because the 5 times 2, right, would be 10. In a rush, I place too many of them, and that's going to then bring this back to a what? 1,000. So what I'm doing right now, these are the 4, these are the 1. I'm going to just create the opposite order, give them back whatever, the 55 cents, 56 cents. Wait till I get filled. I got filled, and this now buying power is at $1,000. But I did have some other things there. Okay, so this is now iron condor fixed. This is a $5 wide, 55 to 60. This is a $2 wide from the 68 to 70. But all that matters, it's outlay of the capital. Outlay of the capital. Having done that, I want to now jump on my IWM. I know I have a 15 minutes, but I believe that I can do it. I believe that I can do it. So how do we do this? Well, we need to first make sure that we understand where IWM is. So IWM is sitting right now, IWM at 191.37 space. Okay, and I'm picking here 194. Because I'm picking 194 call, I'm going to be buying 196 call. Now, this is all good in the theory, and I want you really to look at me to understand this. But where are the footprints of the dinosaurs? Where are the footprints of these big institutions? That's where I want you to turn your attention to. So, what I'm doing right now is bringing up the option chain. No, actually, let's start with the chart. Let's not get confused. IWM, I'm bearish. I'm bearish on IWM because I want to place beyond the unfilled orders, beyond the red UFOs, my sold unit. So we saw that this area is right here, and we want to do it. And this is the 233. Let's see the calibration of the 144. Yeah, it doesn't show up. How about the 89? I'm going to run out of the time. I'll do this one, and this is the one that I really want you to pay attention to. It's right here in this area that I'm considering 194. But if the big institutions are not that level, if the big institutions are 200 or something like that, I'm going to do 200. Now, the only difference is that I'm trying to do on options that are expiring today. So when I go there, I will really need to see what is there that I can get for the 194, 196. If this thing works out for me, then that would be good. Even if it's just a 17 cents or something like that. So let me now go to the chain and be aware of it. There's no time to repair this particular trade. There's no time, because I'm selecting not the February options, not the March options, today expiry. So the premium is not going to be rich. Premium is not going to be rich to begin with. So I'm selecting January 28, and I hope that's actually clear to everybody, that this is a trade that by the next time we meet, we're going to know whether it worked or it didn't work. So I'm hitting here 194 and a 196. I believe that's what I typed in. Let me just double check here. 194 and 196 based on the red UFOs, at the red UFOs. So I'm above it. Now, if the institutions are not there, I'm not doing it. Well, I kind of don't remember what you did before. Well, why don't you remember? Because all that I did, I looked at the footprints, open interest, and also the volume. Open interest, 7,661, 2,500. But look at the next one. Look at the one right below. And let me just change color to maybe blue. I'm going to change. Isn't this even the bigger number? And this is a volume today, and it's at 195. That right there, it's gonna cause me to change my mind. I'm gonna be safer, and I'm gonna go only dollar wide, which means I'm gonna still keep the 196, but I'm gonna be selling the 195. Having said that, I'm gonna hurry up and do this. I'm moving this thing up to 195. So the space that I have between the current price and this thing has now dropped, it's about 15 cents to the, I can also call this cushion if you want, or the out of the moneyness. It's basically, what is it, $3.85 of the protection I have. $3.85. But then the question becomes, how much of the credit am I going to be getting on this particular thing? Well, without any regrets, we should know that buying the 196 and selling the 195, it shouldn't give us a premium that is too rich. But even if it's 10 cents, that's a 10% in a day. That's going to sound very good. So let's stop talking. Let's now do this right here, because I'm afraid we're going to run out of the time unless we go ahead and do it. So typing the IWM. And again, this thing is dancing, you know, like I type in 191.15 and now it's a 191.38. So I'm pointing out to you again, this is intrinsic value. This is a delta. Out of the money is 192. Out of the money is 193, 94, 95. And I'm going to click right here. And as long as it gives me a 10 cents, bingo, it's giving me 10 cents. And I'll do the 10 contracts. Why doing 10 contracts? Because that's $1,000. So at least you're then earning, what, $100. Cent, bingo, I got filled for 12. If I got filled for 12, that means it's even better, right? So I got filled for 12. Okay, now let me repeat slowly what we did here. And I do need to record the exact price, 26 cents and the 14 cents. So I got the 26 cents here, and I got the debit of 14 cents. Okay, I'm gonna do this, and I'm gonna just call this bear call maximum profit. This bear call maximum profit, it has basically 26 minus 14, which would be 12. That's $12, but because I did the 10 contracts, it was a worthwhile doing. It was a worthwhile doing. So I did the 10 contracts, and by the end of the day, we'll know whether or not we keep that $100 or not, $120, right? So think about it. In this particular case, if I would now revisit this thing, and it's just, okay, repeat to me, what is the outlay of the capital? It's not even 900, it's only what? 880. So that's mean I'm making 12% in a day. 12% in a day with the 10 contracts. Now again, I would suggest do one contract, because you don't even know the strategy yet. You don't even know the strategy yet. Now let's look at over here. What do we do over here on a 68 and a 70 for XLE? Okay, if you have any questions, please type it in. Yeah, Mark typed in, but the liquidity of the 197. Yeah, let me just see, what was the liquidity of the 197. If the liquidity of the 197 was better, maybe we could have picked that one too. So in that case, I would probably have to go with 2 contracts, right? But anyway, now the trade is in, you know, like if this, then that, you know, like that's not what I want to entertain, Mark, right now. I want to actually go back and demystify a little bit more. What did I get here? So we had, I'm going to pick the one that I got filled for 55 cents. 129 with 74. 129 with the 74. So on this one, I got credit of the 129. Over here, I got a debit of 74. credit, debit, okay, and then this was a $55, right? And how do we get the $55? 129 minus 74. That's the way how we got. So we actually have a two bear call spreads, but this bear call spread, it's add-on. It's add-on. So I will spell out here the XLE bear call spread is add-on to the existing bull put, which makes it into what I like to call the IC, iron condor. And what is the iron condor? Two short verticals. Okay, while the bear call spread, I thought I'm going to do this, right? I thought I'm going to do $200, but obviously at the end of the day we said that's not what we did. We actually came up with the better one, and we came up with the better one because of the simple reason the institutions traded at 195. So I had a choice that I can pick the 195, 196, or as Mark has pointed out, I could have sold the 195 and then bought the 197, which would be then $2 spread. So if it's a $2 spread and we're investing $1,000, then we would do 5 contracts, while on the other one I actually did 10 contracts. So either way, so let me just price it up here because we're almost out of time, and I want to see what that situation would be. So I'm going here 195, 196, and let's just double check here volume and open interest. Volume and open interest of the 197. Wow, look at this. Yeah, so in hindsight, 195, 197 would do the trick. So let's go sell. I'm going to just price it, Mark. I'm not going to fire it in. On your end, you can do whatever you find suitable, but it needs to make sense to you. It needs to make sense to you. I don't know. I can't see the 197. Okay, so the 190. Okay, it gives me the 28 cents. So in this case, it gives me 28 cents. So this would be giving me a credit of the 28 cents. But then how much would I be actually risking? So on that 28 cents, okay, let's bring it down to 172. Okay, so that would be 172. Let's just pull up the calculator. It's probably the safest thing to do, to compare the two things, right? So if I'm getting the 28 cents while risking 172, that's a 16%. And what do we had on the other one? On the other one, we went ahead and we got the 12. So yeah, you're right, Mark. This would have been a better choice, because this would be giving me 16% rate of return, okay, versus the one that I did with the 196, and I bought well, actually 196 was bought and a sold unit was actually 195. That gave me 12%. So yeah, that's 4% more. And in terms of the danger, they both have a danger at the 195. The danger is at 195. Yeah. But what would need to happen, the IWM would actually need to rally in order for that to be wrong. So anyway, we are now at the top of the hour. I want to thank you once again for attending this. I appreciate nice comments here from Mark, from Joe, from Thomas. So I will do the sharpening session at the beginning of the next month, and it's quite exciting to be on the team. And I want to wish you all the best and stay hedged. Goodbye.